Good morning and welcome to the WREA, Wisconsin Retired Educators Association, Protecting Your Future Pre-Retirement Seminar. My name is John Green with Association Member Benefits Advisors, along with my co-host MJ Woodall. We'll be kind of doing some of the air traffic control, behind the scenes conversations, monitoring the chat and things like that. Your executive director of WREA, Diane Wilczynski, will be sharing with you today, going through just some of the steps that you need to do to be prepared for retirement if you haven't retired already. But just real quickly, before we get started, a couple of housekeeping details. All participants are in a listen only mode. And what that means is if you have questions or you want to chat or make a comment, please put that into chat or Q&A. MJ and I can follow that and respond if necessary, or stop and ask Diane questions and things like that. So we've got a pretty full agenda today, but to help us understand who is on our calls today, I want to launch a quick poll to kind of tell us when you plan on retiring. That way Diane can kind of navigate and place her comments directly on some things to think about out there. So if you're planning on retiring this year, 1 to 2 years, 3+ years, or if you've already retired. So let us know what those are out there. Looks like we've got a full group that have already chimed in here. So I'm going to end that poll and share the results out there. So we've got, most of you are still 3+ years out, which I applaud you for jumping on early. And you're going to see at the end of the conversation, after Diane kind of walks you through the steps of your great pension plan and your retirement process, what some of those educators who have already retired have told us about preparing for retirement. And those of you who've jumped on early before retirement, you're in the right position, because this is where you really want to be. So I'm going to bring in Diane. And Diane, why don't you introduce yourself to this group and tell them about your background in the classroom and then what you're doing right now on behalf of retired educators.
Absolutely. Thank you, John. As John said, I'm Diane Wilczynski. I'm the executive director for WREA. And I have been retired since 2011 and then came to work here at WREA. Prior to that, I spent almost 40 years with the Sheboygan Area School District as a German teacher and an administrator. So I have a variety of experiences. I also worked after retirement with some school districts on a consulting basis. And so pretty wide experience as far as what the issues are as far as educators go. We also work closely with a lot of school districts, so I still keep in touch with administrators and with some of the staff in some of the school districts. So today what I'm going to do is kind of do a high-level overview of the Wisconsin pension system, the WRS. So when I refer to the WRS, that's the pension system. And that's the system that all of you participate in because you are an educator. And you contribute financially, and your employer also contributes financially. So we give these presentations free of charge across the state to whoever wants them. So just to give you a little bit of a background on the retirement system, it covers public employees, over 652,000 participants. Now that's not just educators, it's anybody that works in a school system. It is also policemen, firemen, judges, county, city workers, legislators. It's a wide group that participate in there. Some of them have a little bit different plans, but they all benefit from the system. Right now, there's over $140 billion in assets, and we are at 103% funded. Now, you're going to ask the question, how could you be over 100%? Well, it depends on who's rating the system as to the criteria they use, and then that comes up with the percentage. I will tell you that percent makes Wisconsin #1 in the country as being a fully funded program. So it is a very solid program because not only do the employer and employee contribute, but also the investments are done very wisely. The system also pays out over $6 billion annually in benefits. And that's a lot going back into the economy, not only in Wisconsin, but wherever the retirees live. John, next. So as a working employee, all of you get an annual statement. The one thing I do need to stress very much is when you get that annual statement, please read it. and verify that the information is correct, especially in the boxes that say earnings and service. Because when you do get to retirement age and ready to retire, the Employee Trust Fund, which I call ETF, will look at that statement, and that's what your annuity is based on. So if there's an error and it's not corrected, it could work against you in the end. So keep track of what those earnings are. And if there's any errors in them, please check with your HR department. So right now, as of January 1st, and this is adjusted every year, you are paying 6.5% and your employer is paying 6.5% towards your retirement. And that, of course, then there's interest also that's added into that. January 1 of 23, it'll be adjusted again, may go up, may go down, may stay the same. Okay. So question often comes up, so can I add more to my account if I want to? Can I make a separate contribution? Yes, you can. Let's say you want to contribute $100 every paycheck. That goes into a separate account when you're working, but then is all combined together when you get your retirement benefit. Now, something to keep in mind, a lot of school districts offered what's called a TSA, tax sheltered annuity. That is completely separate from your WRS account. Right now, you have an account at ETF with your name on it. If you have a TSA, that is outside of what your pension is. And that you put money in if you have one every month, and then that deferred, the money is deferred, basically your taxes, until you retire. And then at a certain age, you have to start drawing that out. But that TSA is not included in your retirement pension when you retire. So keep that in mind. They are separate benefits. As a teacher, you can retire at age 55. If you're law enforcement firefighters, it's age 50. Now, keep in mind, however, if you retire at age 55, you are not going to get your full benefit. There's a belief or thinking out there, which actually does play out. But if you're age 57 and have worked at least 30 years, there is no age reduction factor when you get your benefit. Anything below that, and there will be a percentage reduced on what you get for your pension. Also, if you retire before age 55, all you're going to get is your portion. You will not get the employer portion. The other thing's going to happen is you're going to get hit with taxes. Federal and state penalties could be anywhere 20% or up. So the advice that people get is leave your money in. Let's say you leave teaching before age 55 because you just can't take it anymore. Leave your money in the system, in the WRS. It'll continue to grow, continue to gain interest. And then when you get to be retirement age, you can then start drawing it out and you'll get it all, your portion and the employer portion. So it is not a good idea if you leave the education field before 55 to take that money out, unless there's an extenuating circumstance that you really need that money. Okay. You also have a death benefit. As an active employee, which means you're still working in a school system or in a area that contributes to the WRS. The death benefit that is paid out is to your beneficiary, and that is all the money that's in your account, both the employer and the employee. And so that's another thing on your statement of benefits. Make sure your beneficiary is up to date. There's also a status called inactive. And this is kind of tricky because what inactive status is, you've retired from a WRS school or employer, but you have not yet gotten your retirement benefit. So let's say you retire June 15th and you're due for your first payment August 1st. If you die between June 15th and August 1st, you're in inactive status. Then all your beneficiary will get is what you put in, which is actually half. You will not get the employer portion. Okay, so I don't think this happens very often, but it is possible. So if you need to change your beneficiary, There's a form on the ETF website. It's called the Beneficiary Designation Form that you can fill out. You can actually change it as often as you want to keep your beneficiaries up to date. If you do not update your beneficiary, let's say there's been a divorce and a remarriage, and the person did not change their beneficiary, there's a likelihood that the first husband or wife will get all the money and not the current one, because ETF has to pay on what is on file in their office. It does not matter what's in your will, but only what's on file with them when you pass away. Okay, you don't have to list a person. You can list an estate. Here's the order that ETF has to follow when they pay out if there is no beneficiary designated. Your surviving spouse or domestic partner, grandchildren, then grandchildren, parents, brothers and sisters in estate. If you want your money to go to a nonprofit, you can do that. If you want it to go to a school system, you can do that. So that beneficiary does not necessarily have to be a person, and it can be more than one person that you designate also. Okay. So there's two ways that ETF will calculate your benefit. And the thing to keep in mind is that once ETF calculates your benefit both ways, you always get the higher of the two. One is formula, the other is the money purchase. There's also a lump sum that you can get if you don't have a lot of money in the account. If it's a small account, you can opt for that lump sum. But if you've been working for many years, that probably doesn't apply to you. All right, so let's dive a little bit deeper into those. The formula calculation basically is based on the years of service and your age. And so it's also, this is where like the three highest years comes in. So the number of years, your age when you do retire. And that's why we say if you're 57 and you've got at least 30 years, then that age reduction factor doesn't play in. Anything less than that, and then you see this kind of money. Now, keep in mind that bottom number, that 2,367 cents, because now let's go to the money purchase. The money purchase is basically based on all the money that's in your account. And then there's a factor that comes in. Now, you can see here that the money purchase is much lower than the formula benefit was, which means, as we see on the next slide, that's why you will get the formula money amount. Now, this is before taxes, keep in mind. And yes, taxes are taken out. So it's always the higher of the two. I have never known of any situation when they don't pay out the higher of the two. So that's to your benefit that they calculate that for you. And they will let you know when you get to closer to retirement as to which one they're going to be using. Okay, next one. So the one thing that you will definitely have to remember is there are a lot of annuity options that you can look at. As I said, now when you are an active employee, you have an account with your name on it at ETF. When you retire, that account is closed and all your money goes in with all the rest of us. And so that's what allows the State Investment Board to do the wise investments that they do and get us the good returns that we've had. Now, the last 2 years, the returns have been very good. This year, not so good. Everything is pretty much coming up negative so far. So I don't think this year is going to be very good. But most of you said that you have 3 or more years out before retirement. So hopefully the stock market will bounce back. And then when you get ready to retire, that first check you get is going to be pretty good. Also, the thing to remember is you cannot outlive your benefit. You will always get an annuity payment until you die. That is the benefit of the kind of system we have, which is a defined benefit as opposed to a defined contribution. And there are many Now, I won't say, there's a few states out there that thought they could save money by changing from a defined benefit to a defined contribution, only to find out the defined contribution is more expensive. And so have reverted back to the others. All right, so now let's go into the options. Next one, John. And I'm going to just do kind of an overarching, because when you get to retirement, you will need to sit down with a representative from ETF, and they will go through these in much more detail for you to decide which one you want. Now, ETF will not tell you which one to take. You have to decide that based on your circumstances. They will give you what each one means, and then you have to make that decision. The first one is your annuitant's life only. So that means you get a check for your life only. There's nothing for beneficiaries at all. And so when you die, it's done. And if there's any money left in your account, that then stays with the ETF. The next one is life or 60 payments. Again, you get it for life, but if you retire, let's say at 65, if you take the 60 payment guarantee, and that 60 payment is 60 months. If you add on 60 to your age, that's how long then, if you die before the 60 months is up, your beneficiaries will get the remainder of that 60 month that's in your account. If you die after the 60 months, they don't get anything. Okay. The same thing with a life or 180 payments. You get it for life, but if you die within the first 180 months, they get the rest of that 180. If you die after, there's nothing. There's also another one, which is, it's fairly popular amongst retirees. It's called the named survivor. And the named survivor is really a person that co-owns your policy. And a lot of people, if they take this one, they put their spouse as their named survivor. Now, the named survivor cannot be changed by you. Once you designate who that person is, it stays. The only time that that name can be changed is in like a divorce, and a judge can change that. That's the only time. And your named survivor can only be one person. It cannot be 2 or 3 people. And again, the options that are up for you are there for the named survivor as pretty much like the regular ones. Now, there are some stipulations with these, and this is what gets a little complicated, and where ETF can give you probably a much better idea of this, is if you pick the 75%, for example, it's payable to you for life, but then if you die, 75% continues on to your named survivor. If you pick the 100%, you get it for life, but then when you die, the 100% goes to your named survivor, and so on. Now, the restrictions on some of these is there's an age difference that you have to be careful of as to what that age difference is between you and who that named survivor is. And it's either 10 years or 19 years, depending on which option you take. Okay, so again, you have to be careful with this. And if you do have your spouse, again, if your spouse is older than you don't have a problem. If your spouse is younger than you, then you may come in, you'll have to look at that age difference. So again, this one you got to think seriously about, because like I said, once you name that person, it can't be changed unless there's a divorce. So it's a little bit more tricky to work through this one. Okay. Okay, there's also another option that this is why it gets kind of complicated, because there's so many options to think about as to what's right for you. There's an accelerated annuity option, which means that let's say you retire at 57 and you want to take the accelerated annuity. What ETF will do between 57 and 62, because they assume that at age 62, you're going to take Social Security. So they will pay you between 57 and 62, your pension, plus what they estimate you would get for Social Security. It's kind of an upfront payment, and they'll pay you that during that time period. Once you hit 62, the Social Security payment is gone. You revert back only to your pension because they believe that at that time, you then will get your Social Security. Now, not everybody takes Social Security at 62. It's really your call, but they're making that assumption. So you get a larger amount of your annuity payment from age 57 to 62, and then it drops back when you hit age 62. But that is another option for you that you can take. Okay. So again, just as a review, your beneficiary, it has to be listed at ETF, and you can change it as many times as you want. And again, it doesn't have to be a person. It can be a charity, an estate, whatever. But remember, whatever the latest form that they have on file is what they have to go with as far as what they pay out. Your named survivor, it's only listed at the time of retirement, and it's one person, cannot be changed unless by a judge, and they co-own your policy. And again, there's age factors that come into play here. I think this was, and it's just my guess, I'm not sure, I haven't looked back, but I think IRS had something to say about this, because some people may have been thinking, well, this would be a good thing to do for a grandchild. Well, the difference between when you retire and the age of a grandchild could be much more than the 10 or 19 years. So I think that may have had something to do with it when they put that into place. Okay. Now, if we were in person, I'd ask this question to ask you, how many of you know if you're in the core only or if you're in the variable and the core? Most people know, not everybody does. The difference between the two, the core fund is once you retire and whatever that first check that you get is, your pension can never go below that. That's called the floor. So let's say you get $2,300 that first month. Doesn't matter what the stock market does. It always can never go below what that core is. Now, in the good years, it'll keep going up. But then in the bad, if there's bad years, it'll go down, but it stops at the core. The other good thing about the core is there's a 5-year smoothing period, which means if you've got some good years and some bad years, they take a look at 5 years and smooth that out so that people in the core are not hit as hard as those in the variable. Now, the variable is by its name, it's risky because it's totally dependent on the stock market. When the stock market is good, you get really good increases. When the stock market falls, you lose it. There is no floor. And this past year, the variable got, I think, like 14 or some percent, really good. This year, if it continues the trend, they're going to lose it because right now, every month that's come back has been negative in the variable. That is also why ETF does not allow you to have all of it in the variable. You can only have a portion of it in it. So it's kind of a security for you that you don't lose all of your pension if you have it in the variable. Okay? So the question that people ask is, okay, I have some in the variable, stock market's not doing good, I want to get out, can I? Yes, you can. However, once you get out, you cannot get back in. And the cancellations out of the variable only take effect on January 1 of every year. So let's say right now you've got money in the variable and you say, this isn't going to work for me. You can send a letter to ETF right now saying you want out of the variable. That would be effective then January 1 of 23. You can do it as a working person. You can do it as a retiree, either way. And there's a form on the ETF website that you can use. You can fill it out, send it back by snail mail or email it back, whichever way. And then they will process that and it'll become effective the first of the next year. So that's your safety net kind of. Okay. So again, yes, you do pay taxes on your annuity. You'll get a statement at the end of the year, like you do with your regular paycheck, that says how much income tax, both federal and state, has been taken out. If you do not believe that there's enough being taken out, then you can write to them and they'll send you a form where you can then adjust how much is taken out for federal and Wisconsin taxes. There's also a tax calculator that you can go on ETF and kind of figure out what your taxes are going to be. And remember, there's no Social Security, Medicare, or any other payroll deductions that come off your annuity. That comes off when you're working, does not come off when you get your annuity checks. Okay. Question often comes up also, so I want to retire, can I go back to work? And the answer is yes and no. If you go back to work for a school system or a company that contributes to the WRS, you have to be careful because you fall into the category of a rehired annuitant. And there are rules that you have to follow. Right now, there has to be a break in service of at least 75 days. Now, there's been legislation out there because of the shortage of teachers that they want to reduce that. I have seen some legislation in the past to as low as 15 days. Well, that's going to bring IRS into play because their requirement is that it's a good faith termination. They don't view 15 days as a good faith termination. So that's why the 75 days was put into place to make sure that they know that they're done and have thought about it later. If you want to go to work for a non-WRS employment, doesn't matter, you can. There's no restrictions. You can get work full-time, get a full-time paycheck, and still get your annuity. So it's only when you go back with a WRS employer that you got to be careful. Now, if you do go back, you also cannot work more than 2/3 of full-time. And any HR department has all these rules and regulations, so they know and can advise you. There's also a handbook out there, information for retired annuitants that you can get on the ETF website that talks all about this also. Now, if you want to suspend your annuity and work full-time, you can do that. And you do not have to start taking your annuity right away if you want to go back for a WRS employer. But be careful because you don't want anything to happen to jeopardize you losing or suspending that pension, because that's part of your future. Here's some contact information. And this PowerPoint, by the way, will be on the WREA website. So you can come back and look at these if you want. The one that I refer to, the Department of Employee Trust Funds. If you haven't gone there, go there. It has a wealth of information, all kinds of brochures and papers that you can look at that give you good advice as to when you're thinking of retiring. The other thing that I didn't mention before is, especially since a lot of you are 3+ years out, when you're about 6 months prior to your anticipated retirement, contact ETF and they'll send you a retirement package. It'll have all the forms and everything you need in there. That does not commit you to retiring when you anticipate. You might make a decision and say, I want to work 2 more years. You can do that. You just have the information that talks about where you are, what you want, and what you want to look at. So do that so that you have all the information. And then when you get ready to retire, contact ETF, set up an appointment with them, and they'll go through all the forms and everything with you. And don't worry, if you make a mistake, they'll help you correct it. They're very helpful because I remember back when I had no idea what I was doing. And I did make a mistake on one of my options and they corrected it for me, helped me correct it. So they're very, very helpful with everything that they have. Again, if you have any, I think there were a couple of questions in the chat. I wasn't monitoring them.
There are a couple of great questions, Diane, and I appreciate
I
these
can
coming
answer
in.
them.
All right, the first one we have received was talking about when you retire and you've got that named survivor that you designated. What happens if that named survivor passes away before the annuitant does, before the retiree does?
If they pass away before you do, then you still keep getting the payments, but then they'll stop upon your death.
Okay, so you can't redesignate a
No,
second
no,
name
no,
provider.
you cannot redesignate somebody else. No,
Okay.
no.
All right, great question there. And then Kim asked us, talking about the variable fund with the core and switching back, does all your money from the variable fund go back to the core if you switch, or does some of that money stay there for later purposes?
You can designate how much you want to go back to the core. So you could keep some in the variable again, but again, keep in mind, if you decide you want to switch back, you can't. So whatever part you designate to go to the core stays in the core.
Outstanding. Super questions. Diane, thank you very, very much. If you've got more questions, drop them into chat, put them in the Q&A. All right, we have another one that just popped in here. Stephanie asked, how do I know if I have the core or variable? Is there a form? Is it online? Where can they check to see?
It's not online yet because that's confidential information. Look at your annual statement of benefits. It'll tell you on, I can't remember which section it is, but it's on towards the bottom of the first page. It'll give you a little chart, and if there's money, it'll have it an example of core and variable. If you have money in the variable, that means you're in both. If that variable column is blank, then everything's in the core.
Great.
But it's on that. That's why that annual statement of benefit is so important. And look at it, go through it so that you know. Was it page 3? Is that what it is? Okay, I know it's there. I can't remember anymore which one it is.
All right, super. Thank you again. All right, we've got lots more questions coming in here, which I love here. All right. Let's go up. It is on page 3. Okay. When do the annual statements come out? And
I think it's around the 1st of April, if I remember. I think that's when it came out this year.
Okay.
I think that's about the time it comes out.
If they don't remember receiving it, don't have it, can they go request one online, look at the statement
Then
online?
what I would suggest is have them call that number at the ETF and tell them that's the basically the customer service number, and tell them that they didn't get it and they're requesting one. It is not online because all that information is confidential. So they're at this point, ETF does not have it online. They're working towards that with secure login and all that, but they're not there yet.
Okay, and this may be a springboard off of that. We had an individual ask about, there were some times where they had full-time employment, but it only shows they worked a certain less amount of time. Do they still call that same number to get that correction process started?
Yes, and now if there is the one thing that you need to be careful of, because if you look at your all of the years of service, if you have an odd number like a 0.75, that means there was some part-time work in there someplace. And they count that part-time work also, and they calculate it on a full-time basis. So I know when I retired, I had like 39.75 years. So I know I had some part-time work because I started in January. So that's why those odd numbers. But yeah, if they think it's wrong, first check with your HR department at the school district. And then if you can't get an answer, then call ETF.
Okay, great. Another question that came in. We're getting some great questions. Keep those coming. We love this. Someone, Kim asked about, does your employer, school, district, whatever, have to allow you to add additional contributions to the retirement fund, or can you do that directly out of your paycheck?
Contact ETF. That's where you'll have to kind of go through them. And then you will set that up through your district, but I don't know of anybody that doesn't allow it, but I would say contact ETF directly. They can help you walk through that.
Okay, so there is a possibility that they would allow you an outside transfer out of your
Possibly,
savings or something like that.
Yeah.
Okay. All right. Here's a birthday question. If you retire in June, but your birthday is until August, do they consider your age that you'll be in August, or the age that you are in June when you retire?
They usually will look at the August one, but there are some circumstances where it may be June, depending on the date that you retire, when in June.
Okay.
And how far away from your birthday it is. So again, that is, it's all over the place with that. So that's a question that you would have to direct to ETF. I can't give you a definite answer on that one.
Okay, so I do encourage you to go out and look at etf.wi.gov or the 877-533-5020 to start that process there to look at that. So Diane, thank you so much. Again, if you've got questions, comments, put those into the chat section or the Q&A section. We can stop along the way. I do want to kind of come in here, Diane, and to talk more about WREA. And WREA is there for you as active educators just as much as they are for retired educators. And back in the early spring, we had a meeting with a lot of district leaders from the WREA all across the state, and we asked them two questions. What do you want pre-retirees to know about WREA? And then what do you wish you would have known before you retired? And so we got some great feedback, and I want to kind of go through these things here to help you understand the value of WREA and why you may want to consider becoming a member, taking advantage of what they have done for you, what Diane and her team and all of the WREA retirees that are involved here. WREA is a state organization, but it also has local chapters, and they are so hyper-focused on protecting your pension. As Diane mentioned, you have one of the strongest pensions in the nation because of the efforts of WREA. And so she constantly talks to her members about paying it back to, or paying it forward to those of you who have not retired yet, because somebody did that before even the current retirees that were involved. So it's important that you understand WREA is there for you on that behalf. And being such a legislative advocate for public education right now to help support you in the classroom, make your working conditions better, things like that. And WREA isn't just a group of retirees who sit around, collect a pension check, and just talk amongst themselves. They are back involved in the community. They're back serving those schools. They never left that heart, even when they left the classroom. They're still back involved, making the lives of the students as well as active educators even better as a result. So another reason to join. And so I asked these WREA members, tell me about your local chapter. Tell me about those that are right near where you retired, what it's like. And they all came back. We're a friendly group. We're fun. We're a group of lifelong learners. It's not just after you leave the school, you stop learning, you stop doing things. Lots of education there involved in that way. We help the newer retirees to understand what to expect, both financially and socially, because there are some things that change once you walk out of that classroom. The local chapters are involved in book drives, volunteer work, still staying actively connected to that education community out there so that they can benefit from their WREA relationship. One thing they also wanted to point out, and Diane, I want you to kind of address this just a little bit. We are not WEAC. So can you kind of give a little bit of a differentiation between the two? Because oftentimes people see the W and they think everything that comes after it's the same.
WREA, for example, we are nonpartisan, which means we do not endorse any candidates. We are political, so we do focus on issues that are relative to our people. WEAC is they have a PAC, so they do endorse candidates. And so that is the big difference that we have between the two. The other one, WEAC, serves the active people who are still working. And we do the primarily retirees, but we also can work with and represent people who are still working.
Great, thank you very much. And then we asked the WREA members, what do they wish they would have known, or what would they tell active educators now to be prepared for before they retire? And they came up with two different directions. They said, financially, you need to think about these things, and then socially, you need to think about this based on their experience. And they came up with 6 really good tips. And I encourage you to write these down. Those of you who are 3 years out or so, I appreciate you being on here because you're already number one, understanding these things. Know what your saving sources are and how those change as you age. Diane talked about the pension specifically. And in Wisconsin, you've got a really nice pension system, plus Social Security, plus then you've got that third leg of your own private savings, be it a 403B, 457, IRA, something like that. But understand how those change as you age, and the impact of cost of living increases or variable, those type of things can really make a difference for you. They came back and also mentioned, especially because teachers, a lot of them retire at 55, 57, that type of thing, understand what your benefits are pre-65 and after 65, meaning mostly Medicare, but those things do make a difference. Some things that you leave from the schoolhouse, you're not going to take with you. Some you might, and they stop at 65, then different things take over. So it's important to understand that. Today, the first step, learning about your pension system, how it impacts you, how you can impact it. And again, that's a huge, huge role that WREA plays on your behalf, and why we need your voice to make sure that that pension stays as strong and well-funded as it is, and gives you those 2 options that you can make out there for your retirement years. Just as you're doing now, start planning many years before you actually think you're going to retire, because many of these retired educators have told us they didn't understand what they were going to lose when they left the schoolhouse, or they didn't realize what the cost was because maybe the school was subsidizing some of those benefits, things like that. And then as you move out into this period where you are now on a fixed budget or a one check a month system, depending upon whether it's, pension or Social Security, not every couple of weeks or every twice a month, learn how to budget for that. And then just the generic, get your financial ducks in a row before you retire. Again, several of you have chatted in here about, well, I've got some discrepancies on my time with service time, or I've got this with beneficiaries, things like that. Get all that done before you retire, because it's so hard to fix it at that point. And MJ and Diane and I have all seen, especially, and Diane hit it 2 or 3 times, check your beneficiaries, check them frequently, not only on your pension, but your life insurance, those type of things, because we have too many times taken out death benefit checks to individuals and it went to their former spouse because they never changed it, or it was divided up amongst 2 of their 3 children because the 3rd child was not added on. Check your beneficiaries, get those financial ducks in a row long before you retire, and it will be much more smooth as you move into those retirement years. Because really the biggest thing from a mental standpoint that most of the retirees say is, socially, you've got all this time in the day. What do I do with it now? And Diane, you jumped right in and just kept on working after you left the school after 40 years. A lot of teachers don't do that. And they stop and go, what am I going to do here? It's so important to build those social connections before you retire, and then after you retire with people who were in your same type of retirement or education community. And WREA does a great job of keeping you connected to that type of group there. Learn what your volunteer opportunities are, but some people say, learn how to say yes to certain options and learn how to say no out there, because oftentimes you think, just because I've got time, I need to do something with it. Learn how to use that, but always stay on top of what changes are. And that's the beauty of having a relationship with WREA. Diane and her team and the leaders in WREA are constantly keeping you abreast of the issues that are out there that impact your pension, your benefits, certain threats or positive things to the income that you receive in retirement. So understand those things. Find what you love to do. If it's a service-related aspect, and we see a lot of educators that do this, they're used to serving in the schools, they get involved still back with their school, with their church, different organizations that support those who took care of us throughout our career. And you get a chance now, this whole opportunity to reinvent yourself once you're out of the classroom. And so WREA can help you do that along the way. And WREA has partnered with those of us at Association Member Benefits Advisors. And that's the good news. And we really want to put in just a little bit of a plug here for this relationship, because as you leave the school and you go into this world of retirement, or you take on a second career, which many teachers do outside the classroom, you need someone there to kind of guide you through that, look out for you, be out there looking for your best interest. And that's what we do at Association Member Benefit Advisors, as well as WREA. WREA is huge on being a pension watchdog, making sure proper funding, proper payments, that type of thing are out there for you, helping preserve the benefits that you receive, keep you connected to your local community, to local retirees as well, and then offer up important benefits, discounts, fun stuff, freebies, things that you don't have access to once you leave the school. And that's where we come in. We are Association Member Benefits Advisors. MJ Woodall is our leader up in the Wisconsin area. We work in all 50 states. We've been around for 40 years. We work exclusively with associations who are public servant related, just like WREA, retired educators, active and retired state employees, police officers, firefighters, nurses. Those of you who have given of your career to take care of us, take care of our kids, we partner up with WREA to provide membership services, benefits, things that you may have left the school system out there. And some of those advantages of having those member benefits from WREA and AMBA, they can fill those gaps that aren't covered by your state benefits, your district benefits, or however you receive your benefits after you leave the school, because some of those are not COBRA eligible and they won't be taken out of any pension paycheck or any Social Security check. They're portable. if you leave the state for whatever reason, if you snowbird, if you're moving closer to grandkids, that type of thing, you can take these benefits. They're not tied to a local entity that way. But the biggest reasons that WREA members appreciate the benefits that they can receive through AMBA is that they can extend these benefits not only to their kids who age out of maybe their dental and vision benefits through the school district, but you can extend them to your parents. And what we find, especially for educators who are in the last 3 to 5 years of their career, that usually their parents are still living and their parents' health starts to possibly fail a little bit. And sometimes we see active educators have to cut their career short to take care of a loved one. And with the proper planning and with the proper access to benefits through WREA, you can put coverage on your parents that may help preserve your pension in the long run because you don't have to cut short your career. And it's very important to understand what those are out there. MJ and her team can help you understand all of those benefits for you. Going to show you a little bit of access, how you can get a hold of her in just a moment. Making sure that WREA grows is our #1 priority at AMBA. You can become a member of WREA even as an active employee. It's $60 a year. If you've got a spouse who's not going to receive any type of pension system from the state, they can be an associate member. It's $40 a year. Very easy to get access to. MJ and her team can help you sign up. You can sign up also on the WREA.net website out there. There are 3-year membership options, lifetime options. Just put it to bed and you're done. So great way to get involved, keep protecting your pension, gain access to benefits that you may not have once you leave the schoolhouse, access that you can get for your children or your parents now that aren't eligible for your benefits through the school. You can only get those through WREA. Be glad to help you out in that regard. So I'm going to open it up now. If you've got questions, feel free to drop them into chat. You can put them into Q&A. I would encourage you, if you want to find out about what your benefits are through WREA, what you're eligible for, take your smartphone, open up your camera feature on your smartphone and simply hover over that QR code. A little form will pop up. You can simply select review my benefits, put your information in there. MJ and her team are specially trained to understand what your pension benefits are and then what you're going to lose when you leave the schoolhouse and help you understand where that connection is and what WREA can do on your behalf for that. If you're on an iPad or if you're on your phone and you don't have access to using your camera feature for the QR code, simply email me, jon.green@amba.info. It's John, Jon.green like the color at amba.info, and we'll be more than happy to get you all the information that you need and how we can take care of you in that regard. So MJ, I want you to unmute your phone right now because you work with mostly retirees from the Wisconsin school system. What's the biggest surprise that they run across when they retire? What do you see that they say, I didn't realize I was going to lose this, or I'm missing this, or how do I understand Medicare? What's the biggest surprise that retirees have?
Well, part of it, excuse me, part of it is that they are surprised that maybe they had a long-term care plan that was in place and now they don't have that available any longer, or they didn't have the school is not contributing to that. Other benefits that they had available to them, they just, they're not always continuing those things on. So that is a big surprise. The other thing that we hear from our retirees is that they wish that they would have known about the benefits when they were still teaching. And so it's wonderful because becoming a member of WREA opens up those benefits to you right now, to you, your family, and then those that you want to refer into the programs as well.
Okay, great. Thank you very much. If you've got questions, feel free to drop them into chat, Q&A. And Diane, I want to ask you this question. This is one that came in from Catherine a little bit late. And this applies to my wife, who is an elementary school teacher. She started teaching later in life. So when she retires, she'll maybe have just 20 years in the system. What type of formula do they use to calculate that annuity? Is it a different formula, or is it just reduced by lack of service?
Well, if she has 20, let's say 20 years of working, they will then look at that plus what her age is. And then they'll figure the formula from there. For example, let's say just hypothetically, if there's 20 years of service and the person retires at age 65, there is no rate reduction. but it depends on, where they are and what their age is. So there's a chart, there's a booklet on ETF called Calculating Your Retirement Benefits. And there's a chart in there on page 10 that tells you, it shows you what that age reduction factor is, depending on the number of years and your age. The other thing is that I didn't mention before is if you work at least 5 years, you're vested in the system. So that means you'll get something out of the system with at least 5 years of service. May not be a lot, but at least that's the point that you then have a right to a retirement pension.
Great. Thank you, Diane. Thank you for the reference. I would highly encourage you to go out there and check that out. We do record this webinar. We post all the webinars out on WREA.net, and you'll be able to see all the webinars we do, plus this one as well. That way, if you miss some of the phone numbers, the email addresses, the websites, you can go out and check those out as well. So I'm going to leave it open for just a few more seconds to make sure that we've got all any other questions, chat answered that way. So Diane, thank you very much. I'm going to stop recording because sometimes we have